The Hedgeless Horseman here again for a third time. Third time's the charm. May 18th, 2022. I'll just keep reiterating. I mean, this market is a joke. This market is a value investor's dream. You cannot take Mr. Market seriously right now at all. This is panic selling. There's not a rocket scientist who's sitting out there looking through his spreadsheets and comes to the conclusion that your favorite junior is overvalued by 10%, so that's why he's selling. He knows something. No. This is an emotionally driven market. We've seen it many times before. We've seen it through all of human history, through all of market history at least. And this is what you get. I mean, when I started off, for the first like 4 years or whatever, I typically underestimated just how powerful sentiment is. I believed that the market was thinking like I was thinking. And I couldn't believe how dumb it could be, let's say. I overestimated the market. But it's like, especially in the last year, yeah, probably in the last year, it's like, it's finally hit me on the head just how ridiculously predictable sentiment is, and just how much it actually drives prices of stocks. It's like, once you get that, you'll stop taking anything personal again. And I think your anxiety levels will go down, whatever. When you realize that Mr. Market doesn't know anything typically that you do. Sure, there are, insider selling and insider buying. So yes, there are some stocks, etc. But in the grand scheme of things, it's just sentiment driven. When stocks go up, it gets more people to want to buy. And when they go up even more because of that, it gets even more people who want to buy. Exactly the opposite happens in downtrends. So if your favorite stock is down 10% today, for example, it's not the market knows something. I mean, most of the stuff in this sector is already, you can't make it up. I mean, again, you would guess that gold was at around $1,200. No, it's smoke and mirrors. Mr. Market right now, especially in the junior sector, is not an efficient pricing mechanism. It is completely driven by emotions. And on the topic of how I can see through downtrends, etc., and why I'm not trading or whatever. It's like, and on the topic that you must be able to, if you're doing my strategy, you have to be prepared to sit at heavy paper losses for periods of times. I mean, just look at this. I mean, obviously, a lot of stuff has happened, so I can't compare GDX now to where it was 2011. A lot of stuff was different. A lot of companies were in debt. Since then, they've had to dilute, etc. So I think it's better to just focus on, the fresher the data, the more the companies typically have stayed the same. But look at this, like, you have this long grinding. I mean, this was epic. Obviously, they started off from a higher plateau, let's say, in valuations, etc. That's why I don't agree at all when people say, this looks like, the top of 2011 or whatever. It's like, yeah, but if you look at some, I don't know, some patterns, like, yeah, it's looking like this. Let's say this is looking like this. Yeah, but we're starting off, especially again in the juniors. I mean, the juniors in terms of valuations are already back here almost. So it's like, when you account for how absurd they're already valued, they're not starting from overvalued levels. The broader market started this crash from overvalued levels. So there you don't even have margin of safety. A lot of the stocks in the broader stock market should go down and stay down. Some should not even exist because they don't have a good business plan or whatever. I was like, look at this, okay, extended grind periods of grinding downward action. And then poof, much shorter time frame, made it all back. So I mean, if you compare the time period here, how much more pain in terms of time is there than gain? And that's why I also keep on saying that there will be a next sentiment high, and the longer any down trend continues, the closer we will obviously get to the next sentiment high, by definition. So, like I've stated before, take this for example. I mean, this buy here has a way higher compounding rate than the same level here. Why? Because this the correction had gone on for a lot longer in time. So we were getting closer in time to this. So I mean, obviously you would rather have like 100% in 1 year than 100% in 3 years. I mean, that's a big difference in terms of compounding. And that's what's happening now. So again, at a given level, selling becomes worse and worse because we're closer to the next uptrend and the next inevitable sentiment high. But you can see this like way longer downtrend period, and then poof, up, and then way, a long, let's say it touched this rail here, so it's like started to go to this. I mean, that's kind of fascinating actually. When you look at it, it's like, yes, there was a clear trend here, but in the meantime we had a crash, but that just basically after the crash, after the panic selling stopped, it immediately went back to the same trend line it had been on track on, and then shot higher. Look how quickly these gains materialized. From the bottom here, this was a move from like $20 to $65 in just a few months. So it took this long to go back here. It took this long to get back to the top and then overshoot it. That's why I have no idea when the bottom is in. I just know that for every passing day we are in a correction, it's getting closer and closer and closer. So if you're gonna panic early. If you're gonna panic, I don't know, here. I mean, you would still be in profit if you waited until the next sentiment high. But anyways, like, you don't want to panic at the very end of a long downward correction. And again, it's kind of fascinating. I mean, if you look at this channel, for example, this was the on the back of, well, I think Q1 here was the best rally in juniors overall. But it's like, it went from dirt cheap, but here many juniors were near bankruptcy, to very expensive. Like I said before, First Majestic traded like silver was at around $30 per ounce, even though we traded at 20. So this was way overextended in a lot of companies. Margin of safety didn't exist. They should go down unless silver actually caught up in price and went beyond, obviously. So we had a huge, very long, very tiresome correction. And here it was dirt cheap again, back up, and here it was dirt cheap times 2 because price of gold didn't really go down that much, but miners went down a lot during the flash crash, the panic selling of 2020, the corona crash, and then slingshot higher once this panic selling ended. And right now, and it touched this upper rail again, and now we're in this extended down period again, and right now it's way overstretched again, especially in the juniors. They're like almost down here again. So when this panic selling we're seeing out now, I mean, just look at today. Okay, gold's down 0.26%. That's, a rounding error. So basically, let's say gold was neutral, and since the dollar was up more than twice what gold was down, so the USD purchasing power of gold in US dollars actually went up today. That didn't stop the miners from the mining indices to go down, and many juniors to get punished again. What more evidence do you need? Your juniors, your favorite juniors, your favorite miners, they're being sold uh, by panic selling. It's nothing to do with the fundamentals. It's people that are scared that are hitting the sell button because the markets are crashing. So if you just look at what the price of the commodity did, miners should be pretty much neutral. They were not neutral, but they are swinging wildly. I mean, GDXJ jumped 2% within five or 10 minutes for a while. So you're starting to see the volatility I've been talking about. It's like panic selling. Once that stops and some hope comes back intraday, it jumps 2%. But what I'm more importantly, what I'm saying is that again, this is panic selling. Like this was panic selling, and this at the bottom here, this was also panic selling because it broke support zones, etc. And you can see here we broke in support zones, and this broke support zones. So when you look at it, it's like, yeah, okay, this was obviously a support zone. Price briefly went below, even though they were ridiculously cheap. I mean, Silver Standard, I don't remember the exact valuation, but they had like, I think, hundreds of millions in cash or something. Went down like 10% when gold was barely down. Uh, Panic selling, capitulation selling, people selling because they feared other would be selling as well, and people already were selling. And then it whomp, had the most epic rally I've been a part of. Here, flash crash again, panic selling. People are selling because they're scared. Nothing else. Nothing else. They're selling because they're scared. It's panic selling. Collateral damage from the markets going down. Actually broke below this level. Broke below this level as well. Whoop. Then like 3-4 months or whatever, made everything back and then more. And right now, I mean, it started off with this being kind of a fake breakdown, and then rewarded higher, and now we are stuck in panic selling mode like we were during the COVID crash. So the mining business is not going down in value. The miners are going down in price. So this is collateral selling. This is absolutely panic selling. This is dumb money, for the lack of a better word, getting flushed out. But price should be, I don't know, up here or whatever. I don't know actually with GDXJ because I don't follow that. But you see the same type of behavior. Long extended down periods, epic rally, long extended down periods, breaking of support, breaking of support, breaking of support, epic rally, long downtrend, and breaking of support. There were sheep here, sheep here, very sheep here. There are even more sheep here, because if you account for the actual value of the gold business, this is the price of gold. I mean, here you can, it followed gold, so it's like, gold was doing poorly. The gold business was almost worthless down here, and then it ramped with gold, sure. Then it crashed with gold, sure. I mean, value of the business went down, and the miners had gone far too high already, too quickly, so they were pricing in an even higher gold price. And when gold price turned, the miners undershot. But I think it appears that this period of time, this faked out so many, and this faked out so many, and this was so excruciating that today almost everyone has already left the sector. That's what I think has happened, and when you look at volumes and the immense price to value gap of the miners and the actual commodity. I mean, from here it's just been extreme. Well, especially from here. I think this was like, the last straw. I mean, the ones who had already been burned, then they thought now the rallies, now the epic bull market is coming because it broke, the previous high, so they buy in here and then sit through this. But all I care about is buying cheap, and try to pick the companies that are the cheapest. And I just look at the fact that if this is a proxy for I just look at this fat gap. I mean, again, gold would, like, you would expect gold to be trading down here. I just look at this immense gap, which a gap I've never seen to that magnitude, because the juniors are pricing in $1,200 to $0 per ounce in gold, while gold is at 1,800. What I care about is buying cheap. That's why I never miss any bottoms. That's why I'm part of all the pain until we bottom and go up again. So I'm 100% deployed from the lowest point you can find on this chart up, and then I'm part of the downtrend, and then up. But since I am on average picking higher quality stocks than the average junior stock, my trend is up. But even the best juniors get caught in the cascade of selling. So that's what's fascinating. I mean, think about this. If there's anything you should take away from this, it's that now the miners and juniors are being sold as collateral damage because the markets are crashing. Gold is not crashing. Silver has done quite poorly, but gold is not crashing. Markets are crashing. People sell miners for whatever reason. They're scared. They're selling. So not only are the miners and juniors collateral damage from the markets, the expensive markets going down closer to fair value, but you also have the fact that when people sell like this, panic selling, they do not really care about the fundamentals. So you will have the absolute highest quality juniors getting sold as well as everything else. The crappiest of companies and the best of companies go down. So let's say you have a very crappy junior that goes down 50% in price. That might be a sell. Let's say you have a high quality junior that already was undervalued. That goes down 50%, and that has a, let's say, a expected growth rate of like 100% over the coming X amount of years. Meaning every passing field season, you on average believe that for the next 2-3 years, they will double the intrinsic value every year. And that goes down 50%. So like I've shown before, let's say you have a junior, let's pretend this is a growth stock, and you think that the intrinsic value, your base case is that it will be up here. And that gets cut by 50%. I mean, that's huge implications for your future returns. So it went from, instead of 57% when it's, let's pretend it was overvalued, to like 200. So that's 4x the return. Because nothing happened really for this company. It's just that that got flushed because everything else got flushed in the mining sector because the market got flushed. So it's like a third derivative opportunity. Not only did not the mining sector go down in value, especially the high quality juniors certainly didn't go down in value. And many juniors out there have had recent success that is already priced out of the stock. So what you're able to do during these abysmal sentiment periods is that you can steal an enormous amount of value without taking the risk. Otherwise, let's say you're in a stock, you're betting that they will have great assay results. Let's say you're going to have a negative outcome in 9 out of 10 cases. Meaning that 9 out of 10 companies you're betting on to make, put out barn burner holes or discoveries, they miss. Right now, you can buy the ones that actually, the 1 in 10 that actually increased its value substantially by a discovery hole or whatever, without paying up for it. Buying it lower after the fact of it happening. So this is, price-wise, right now, like I've written articles before, it's incredibly rigged against us because it doesn't matter what a company does right now, pretty much. It will get sold off or it will not get rewarded. So at surface, at face value, we're taking risk without getting any reward for it at face value. Because let's say you take a risk of buying an Explorer, they come out with good news, but the stock barely goes up, or it actually goes down, somewhere in between. So at face value, because you know that in a poor sentiment environment, you would get absolutely slaughtered, let's say, if they came out with dusters. Like we saw in Cartier Iron. I think when they announced dusters on their the gold project they have, it went down 40% and was trading, I think, less than what the shares of Eloro Resources were worth. So obviously that's kind of overextended. So that's what I'm talking about. Yes, it's rigged against us in terms of price, in terms of reward right now. But it's also, if you look at it in a different perspective, it's also rigged for us. Because we can buy value for less than it's worth. Meaning we can steal increasingly higher future expected returns. So if a stock goes down on good news, that's pain for the holder. Well, kinda. I mean, it's rigged against him because he didn't get quote paid at the time for the risk he took at the time. But anybody who's looking at that stock can realize, wow, intrinsic value just got hiked up by 50%, yet the stock price didn't move. Right there, I can steal 50% of future expected returns. That's why, obviously, due diligence in being a buyer in this environment is like, I mean, this is a dream case scenario for any value investor. There is a boatload of value and good results that are not being priced in right now. And they weren't priced in here or here or here or here. Here they were overly priced in. Here you got more bang for the buck, let's say. You had exploration companies that, you know, put out a discovery hole or whatever and went up to 50, 60 million. We have the opposite now. And this was, I mean, it was pretty expensive here as well. But you will have periods that you will get more reward than you should. Stock prices will go higher than what the value of the company is. Same goes for this. The opposite is also true. You will get more punished and the price will go way lower than it should around these sentiment bottoms. So let's say you have a few juniors that have considerably increased in value from this period in time. Let's say value has gone up here. Price has gone down here. So if value hadn't changed, you were looking at this price to value gap. That will get closed one day. If value has actually been increasing, you're looking at this future return. That's all you need to know. I'm Canadian all of a sudden. That's all you need to know. The market is rigged against us and for us at the same time. For current holders like myself, who are fully deployed, it's been rigged against me for a year or more. But at the same time, since I can at least reshuffle, if I have a few stocks that have gone nowhere in terms of intrinsic value, and I have some stocks that have gone up in intrinsic value, even though price went down the same amount. Some of the stocks will have this future expected returns, and some will have this. So if I sell the stock that has not increased in intrinsic value, I'm selling, let's say, a 46% upside. I mean, the juniors obviously have way higher future expected returns, especially the quality ones, than GDXJ, but just use an example. So I'm giving away this future expected returns, because when the market becomes a voting machine, from this point here, it will go up here and deliver me 46%. But I'm buying something that has an expected return of 90%. So let's say double. So yes, I took a loss, paper loss, converted a paper loss to a real loss, let's say. but I bought something with a much higher expected return, even though both stocks were, or let's say every stock was down 50%. But I reshuffled, I took 50% haircut to get a, again, this is not representative. Let's say they went down 30% instead. They went down 30%, all of my stocks, but I exchanged all of the ones that I think should go up 45%, and reshuffle that into the ones I think will go up 90%. So I just value traded myself to a 45% net boost in future returns. You know what I'm saying? I mean, yes, the currency I'm purchasing with, the stocks I own, went down, but I used that currency to buy something that was even more undervalued. So I can't see it now, obviously, because it's like a good quote I saw. Most of your returns are made in bear markets, you just don't know it yet. That's exactly what's happening right now. That's why I'm very watchful of any, some stocks going down here, some stocks going down less, and some stocks being neutral, whatever, and just look at what are they worth, what are they probably gonna be worth in 1-2 years. And then, because the opportunities right now are getting extreme, and some juniors that go down 20%, let's say, in price, if you buy them when they're down 20%, that might translate, in a 2-year period, might translate to, who knows, 150% additional upside. Case in point, again, Cartier Iron, that someone got flushed in that stock. I believe it was, either a stop loss getting hit, anyway, a market sell order probably. That went down 75% in a day and rebounded 300% from that low in a day. That's what I'm talking about. From these levels, any additional down moves in price, on average, when the slingshot move arrives, the returns become extreme. So even if you're fully invested like me, I'm consciously or constantly out there looking for are there any value arbitrage opportunities. So maybe I have 10 stocks I like. Let's say I own 30 stocks. And let's say value is fixed, whatever. And they some go like this, some go like this, and then you have one that's gone like this, but then gets for whatever reason a stop order, panic sell, or whatever. It goes like this. So all of a sudden, with these 4 different stocks here, if nothing has changed in terms of fundamentals, I could simply sell this one, pick up this, and net expected future return arbitrage. And who knows, maybe time goes on and this stock that got flushed goes back here, and this stock goes something like this. Now I can do it again. Now I can sell this by, again, assuming nothing has changed. And maybe this stock goes like that, and this time around, for whatever reason, this stock's just craters. Then I can sell all of these 3 and buy this one, and net myself a future expected return arbitrage. And then maybe this one actually revalues quicker than the others, and they go something like this. So now I can sell these 2 and get into this one, for example. And now I arbitrage myself even more, because I know that the fair value for all of these are actually up here. So it's like, yeah, that's probably the best way I can explain value trading. So even though it's like, in a crashing market where everything goes down, that's harder, obviously. But at the same time, if a stock goes down here versus another stock that goes down here, this alone might be a 50% future expected return arbitrage, because it gets so extreme at these levels. Yeah, consider me biased. Don't treat this as investing advice. Hit a like if you like the video, like the content. Tomorrow is another day, and we're since we know this happens from time to time, and we know we're gonna hit a sentiment high. I mean, in my opinion, it's never been easier to be a value investor, because it's so surreal how obvious the price to value gaps are. So it's like I only have one. I've had a chronic. I mean, I'm buying as much as I can, because I know we're gonna go higher one of these days. And typically, when it comes, it's gonna come fast. Yeah, thanks for listening. Bye.